in this webinar, about a half hour of what we do going into the market trading day and how to use the notes on the website and extrapolate from there what you want to do relative to your portfolio and what you're trying to accomplish on a day-to-day basis. So I thought it would be good to kind of look at the market real time coming into a trading day. So let's start with today's notes, which is obviously July 17th. And what we're looking at today is really hasn't changed a whole lot in the last 5, 6, 7 trading days, in that the market continues to want to move higher, and it's moving really on the Bernanke factor, and I think that that's still the driving element. He's testifying right now, so one of the first things I do each morning when I get up is look at what is out there. I usually start research for the day around 4 a.m. East Coast time and look at what happened in the overseas markets, kind of come into and look at what's happening relative to the U.S. markets, and then do some scans and things to set up the trading day, which I'll go through this morning. But when I look at this, you know, the first thing that is on the platter today is Bernanke and his testimony to Congress. And, you know, the futures were actually negative when he first started speaking. They have moved up at this point. One of the things that I do use, this is Market Watch, which is where I just click to see what Bernanke was saying. But also, one of the first places, the easiest places to go is CNN Money has a pre-market trading. You can get this on CNBC.com. It's a lot of different places, but the only reason I've been using CNN Money for many, many years is that they were one of the first ones that started reporting it, so more out of habit than anything, as well as to what the futures are doing. And you can see they're at 0.3% on the S&P and the NASDAQ, 0.1% on the Dow. Those were actually negative 0.2% about 10 minutes ago. And so we've seen about a 0.5 point bump on Bernanke's talk. And the question is, why would the market bump on his talk? Is that the market is looking for confirmation that the Fed isn't going to stem prior to September, which I think everybody's comfortable with that. But Bernanke's trying to say that there's going to be no set schedule for this, and the market is starting to buy into that rhetoric. And whether, I mean, I think from the very beginning, in my notes I've commented that the Fed isn't going to cut $85 billion on September the 1st. They're going to ladder out of that over a 90 to 180-day period, whatever they choose to do. But it's going to be a slow withdrawal of that stimulus from the market. It's never going to be turn the faucet off immediately. So what you're seeing in the market today is a reaction to the Fed. The second part of the market today is earnings, and I think earnings right now to me are more important going forward than what the Fed does. Yesterday we did start to see a little bit of erosion in earnings reports. Yahoo did not meet expectations. Coke missed earnings. You had a little bit of a trailing of 5 or 6 companies that do matter that posted less than expected data. You've seen some that have posted better than expected data, and all of that is factoring into the market as we go forward. I also wrote a piece yesterday morning on the fact that I think that the fundamentals don't matter until they matter, and when they matter in this market, they're not going to match up to where we currently reside, and I think that's going to be a big challenge for this market on a day-by-day basis. So in the short term, I think you got to take it one day at a time, and that's how I'm coming into today's trading day, and I'm trying to give you my peripheral thoughts because it structures how you set up your trading day. If I'm more comfortable with the longer-term outlook in the markets over the next 90 to 180 days, then I'm more willing to take positions that gap. I'm more willing to take positions that are running. Whereas if I think there's uncertainty on the horizon over the next 15, 30, 45 days, I'm more reticent to take some of those positions, which you see in the models, is that lack of confidence really in this market as we speak. So let's put into perspective earnings. American Express is having struggles today, and you can see in the pre-market right here it's down 4.5%. What's going on with American Express is that they announce earnings today, but you know there's this tax that's being kicked around on debit card transactions in Europe and some of the other foreign countries of 0.2% tax on those transactions. That would really impact, I think, how people use these credit cards. Visa's down on that news, MasterCard's down on that news, but it just happens to be American Express also announced earnings, which weren't stellar either. So you're seeing that. Yahoo announced last night they did not meet earnings, but you can see the stock is up 2.7%. The reason for that is how they managed their press conference following that earnings release, and the fact that they said they understand they have an issue with click-through ad rates and all of that. They're working on it diligently, and the market's buying into that. They're actually giving them, Meyer and the CFO spoke last night, and they gave them the benefit of the doubt on this overnight, and they do believe in Yahoo going forward, so the stock is popping. The reason I bring that up is I got several emails yesterday addressing why I had Yahoo on the pattern breakout with earnings coming up. And I look at earnings, but if I'm comfortable with the stock and where it's at and what it's doing, I will buy in front of earnings. I may take a smaller position or versus a full position, but I'm still going to buy if I'm comfortable with the company, because if I'm trying to get into Yahoo today on the breakout, then I'm not really going to do very well with that, because we can look at Yahoo here on the chart, and you can see in the pre-market it's going to, looks like right now it's going to price out at 27.55 on the open. And if I'm trying to buy on the breakout right here, which is where we tried to buy it at 27, I'm already 60 cents above that. It makes it tough when you pop 2.5 to 3% off of what you want your entry price to be to get into the stock. Now, the opposite could happen. It could have been bad earnings and the stock fell, but that's just the, the risk you take. If you don't, again, going back to these pattern posts that I put up, if you're not comfortable with the trade, don't take it. It's just that simple. I'm not telling you to buy everything that I post. If you don't like it, then go with your gut instincts, not mine. My comfort level is always going to be different than everybody else's, because I'm the one posting the research, and I'm the one who feels comfortable with the research that we've done relative to taking those positions. So that's kind of how I set up the day. I look at what's going on in the global markets, look at the domestic markets, kind of break it down, and then I go back and I look at what each of these have posted relative to what we're looking at coming into the trading day. So the first thing I look at is right here. I have a list of anything that we've posted on the actual site as a buy opportunity. I have posted them right here on this watch list. So I built a watch list that addresses everything on the site. So last night when I updated the site, I update this list right here so that I know what I'm looking at coming into the trading day. Why do I do that? I want it on my trading screen versus having to flip back into the site and back out to charts and all of those things. You can also put it on two screens and set it up so you can see it. However you want to do it, that is your comfort level. I just use it here because I can click on the symbols and I can pan through them. And I'm going to go through these because these are the ones that we were looking at and or that we own coming into today's trading day. And I want to see how they're setting up coming into the trading day. Not that I'm going to change my mind on anything, but I want to be aware or alert of what is transpiring. So AT&T, I'm trying to buy it on a break above 36. I can see these two bars right here that you can see, the light green bars, and I can't change the color of those as part of the software, but those bars right there, you can see the bottom one is the bid, the top one is the ask, and basically you're going to see it open somewhere in between there, so that's the pre-market. So we're looking at it opening right around the 35.90 level on AT&T, and that's where, if you look up here, that right there is the high bar. You can kind of see the pre-market up there as well. So 35.90, we're in the game as far as doing that. Now, here's where you have to make a decision. Am I comfortable enough with where it's trading in the pre-market that I'm willing to place my trade now? So I can go in and put an order in that says buy, 500 T. So it's a buy stop at $36. So if it goes to 36 or above, I'm going to own AT&T at $36. And so I can put the order in pre-market. If you're working for a living, that's how you want to do it. If you're not working for a living and you want to watch the open, then you can trade into the market how you see it opening. Sometimes you may want to wait. I know some people who wait past the first half hour. It's where your discipline resides. As far as how I do it, if I'm in an orderly market like today is setting up on AT&T, I'll go in and put it buy 500 at 36, and so I'll get executed. You know, if in the first 5-10 minutes it goes to 36, then I'm going to own AT&T. GXC, this is the trade on China. You can see the double bottom setup. This is just a reversal off of all the selling in China. I still don't believe that China's going to go very high. Really kind of looking for this to come back up here around the 200-day moving average. And if we get the break above 66.30 today, we'll buy into GXC or FXI, either one. Both are China-based. GXC is just a little broader based. And looking for that to trade up about $3 or 5% off of that. And then, so that's setting up pretty nicely coming. It set up yesterday as well, but it still has not executed into the price that I want to own it at. KBE, which are the banks, you got Bank of America out today with earnings. They didn't make the top 10 list, but Bank of America is up about 0.8% in the pre-market. If we look at BAC real quick, you can see it's going to open somewhere around 14.10-ish on the day. That means that KBE is going to benefit from that, which you can see in the pre-market. It's up around 30.09, closed at 29.95. I'm looking at on KBE, if it gets right above this 30.35 level, this is just, that's a flag pattern. For those of you who look at patterns, you can see the bar, and then you got a flag at the top. That's a bullish flag. It should break up to the upside, and that's what we're looking at on KBE. Gold, this is just a trade on being oversold. Short interest in gold is very high right now. I think if you get any type of a rally in gold, you could see some short covering, and that could be good for $7 to $10 on GLD. So I think the upside there is there in gold. Two trades that are outside of that I don't have posted here are GDX, which you can see broke out yesterday. And I can't post all of these trades, so I try to, you know, post what I think is gives you the better risk profile. But you got a downtrend bottom, you got a ascending triangle. For a reversal to happen, you need some volume to get this, because you're going to it's a trend change pattern. And in order to get a trend change, you need an acceleration in volume or conviction from the buyers to reverse the trend. We got some of that yesterday. You can see we broke above the initial resistance, but you got plenty of resistance coming up at 27.53 in here, so it makes the trade a higher risk because of the resistance zone that it's going to trade into. But GDXJ also is setting up the same way. These are the junior gold miners, and you can see that they broke out as well. And then, of course, you have to look at the sister to gold, which is silver. Silver set up the same way. I think there's a bigger pop probably in silver if gold runs, and you could see silver miners move up nicely, maybe as much as 15% on the upside out of the silver miners. But none of those are posted over here. They're just things that off of these that we see opportunities developing as well. So we'll look at those, and I have those set up on a separate list as we go into the trading day, looking at what I think are things that are akin to this. I mean, KBE, I'm just going to flip over to a different desktop that I have here. This is, I call this a sector rotation desktop, as there's no magic to this desktop other than what it does is that if I type KBE in here, this table right here links to the holdings within KBE, so I can see from yesterday, you know, what were the leaders within KBE and whether or not I want to look at those. BAC, Bank of America, obviously on the upside today, JP Morgan. So I'm looking for some of these to actually follow through on the upside so I can flip through those. And the point of that is that what I'm looking for is I'm always looking for the links out of things that we track. So when you see things that I post in the notes, there's other trades off of those if you want to go and do some research and find some of those trades. If I posted all the research up there on the things that we look at, I'd probably drive most of you absolutely insane. I've probably done that with just what I post anyway. But you can see that KBE is set up to break out. Gold is set up to break out. Yahoo, we already own Yahoo on the breakout here the other day at 27.20ish, and so it retraced yesterday, and now today it's going to open a little bit higher. We'll still watch Yahoo, and we may see how that plays out. But Amgen is another one that you can see broke above the trading range at 102.10. Everything is still okay. So when I own them, I'm just looking to see if we're okay. Is there something that's happening in the stock that I need to be aware of coming into the trading day? And the futures are always going to tell me more than running and looking at news. We also tag news on these news alerts that pop up on them. But if I'm getting a news alert on Amgen, it's probably too late. And I want to make sure that even as we go into a trading day that I know what's going on with each of the positions. Hewlett-Packard opening a little bit lower. Citigroup is just a little bit higher. Kinder Morgan, this is an energy MLP. So you can see that it's moved up nicely. It pulled back yesterday on the interest rate issues. We did have interest rates moving around more so in people's heads than we're actually seeing in the charts, but that interest rate fear is still out there. And I'm going to tell you, the interest rate issue is probably played out for the short term. If we look at TYX, you can see that the 30-year Treasury has built a pattern of spike, settle, spike, settle, spike, settle, spike, settle. If this doesn't spike in the next couple of days, I think you're going to see a retest come back down here around 345 on the 30-year Treasury yield. That'll push bonds up a little bit in value, but I actually think yields start to move a little bit sideways here. I think the greater risk to the market in general and to the housing market, a lot of people have talked about bonds being a risk to the housing market. The greater risk here is employment. You know, hours worked are declining because we're hiring more part-time people. Hourly earnings are declining because we're paying them part-time wages instead of full-time wages. Benefits have been extracted out of that, all relative to Obamacare is the speculation. I'm not going to confirm that that's what it is or is not, but that's the speculation behind it. But if we don't get jobs going in a sense that we are actually hiring permanent positions and wages are going up, I think that's the greater risk to housing than interest.
The broadcast is now starting. All attendees are in listen-only mode.
I don't see yields running with, and the reason I don't see that is you got the Fed too engaged right now with their mouths running. And if you got the Bernanke and the 12 dwarfs running around, that's going to change how Treasury yields move in the short term. So I think right now they're stymieing Treasury yields by the blather, and that blather is helping some of these positions, and there's trades like in HYG, and if you look at IYR, which are the REITs, and if you look at XLU, which is utilities, some of these trades we've put up, but you see the pop in utilities to the upside. These interest-sensitive stocks have started to bounce back. DBY on the dividend stocks, you can see the bounce there. So you're getting a little bit of confidence boost. The interest rates are kind of settling down. And then the next pop, if that's true, should come out of the housing sector, which has not really done well. And you can look at XHB or ITB, either one, and you get a sense for the fact that people aren't trusting the housing market on interest rates just yet. I think some of that will come out. Believe me, I think we've made way too much of whether or not people can buy a house with a mortgage at 3.1 or 3.2% versus 3.7%. That 0.5%, yes, does make a $50 to $100 a month difference in the payment, but it isn't going to stop the housing market. It's not enough of a yield bump. If you get the yield bump above 4.5%, yes, then we're going to start to see some impact to housing, but we got another 100 basis points for that to happen, and I don't see that happening anytime in the short term. So make sure that you're not reading more into what the media is blathering about than is really there. So focus more on what you're trying to do instead of what the media wants you to do. So important part is that as the day sets up, I've just thrown a lot of news at you because those are all the things that and more that I look at coming into the trading day. and then I try to make sense of it into how does it play into the models. And so I've started outlining each of the models here with the S&P 500 model. I don't think you're going to see much of changes today. VXX is the one thing we're looking at coming into the trading day. Was we were looking at that volatility maybe to pick up off. You saw it picking up yesterday a little bit there on this bar. I thought we might get a little bit more volatility today off of Bernanke. So far, he said all the right things, so the volatility is actually extracting backwards. We got stopped out of SVXY yesterday, and on that move down, because we had tightened the stops. We made about 12% on that run, and now we got to watch this. So we're going to be back up at resistance. We'll look and see how volatility plays out today, but I'm still looking at the VXX trade on that coming into today as far as the S&P model. Other things on the model that are there, I like the pullback in energy yesterday, XLE, which you could see we took an entry at 82 on XLE, and we're at 81.34. I still like this trade. I don't think crude is going to back away. I think the China news yesterday pushed crude down. Crude's back up today, was above 106 earlier on the futures. I don't see this being, I don't think this stops in the near term, and I'm just going to go back here real quick to the homepage on MarketWatch. You know, the oil is at 105.88 at 4 o'clock yesterday. We closed at 105.32. On the close yesterday, it was at 106 even, so we're down 12 cents on the NYMEX. So what you're looking at is, I think oil picks up some volatility. I don't think it retracts. I still think that 120-ish is probably a reasonable earmark for crude going into year-end, and a lot of that is due to the Middle East, lack of production out of Egypt, lack of production out of Iran. You got a lot of issues in Brazil. You know, the emerging markets are struggling. I think there's plenty of supply, but it's impacting how, when you get the supply drawdown, unless we start to see this pick back up, you're going to still see crude tick up. And we haven't posted it, but we do own, as a firm, we own UGA gasoline. And if you're going to start complaining about gas at the pump, then you got to look at owning some of these positions. And, you know, so gasoline, I think, it's already talking about $5 a gallon in California. It's bumped 20 cents a gallon in Florida. We could see, you know, gasoline probably push $4 here, which would be about another 50 cents, 45 cents to get there. So that's another upside of, say, roughly 8 to 10% on gasoline. So you've got to look at ways that this news translates into trading on the day. I'm a person who wants to trade based on rationale and fundamentals versus just the technicals. So when you see patterns up here, and that's why I went through all of those, is that, you know, TJ Maxx on the retail side, I still think they're one of the better retailers out there fundamentally, but, you know, the sales data wasn't overly convicting on Monday, but you're still seeing the discount retailers pick up market share, and they're still doing well, so don't count companies like TJ Maxx out. So even though there was a pattern break there that we were looking at, that descending channel, and we looked at the break and the entry there around the $51 mark, you know, and that's been a nice trade on the upside, and it continues. I still think there's upside in that trade. So you've got to have some reason to get into these trades. I always want you to know that I didn't just blindly post these. If you have questions, that's why at the top of the update it says, if you have specific questions on any post, you can forward them to me at jimsnotes.com. So, I mean, use that if you want the absolute, if you're mind-boggled as to why I would think something, I'm more than happy to share it with you. Sector rotation model, DBC, which is commodities, part of that was oil, part of that was gold, which dominates that position, 2620, 2630, I think is the entry on that. You know, we're still looking for that to break above that, so the rotation model would add that if it breaks through today. The only ETF model, I still like this crude picture, UCO. You can see there on the upside, we did get stopped out of that position, but I still like what's going on in crude, as I said earlier, and I like XLE, and I like some of the other things that are out there, and I continue to dig into oil. I don't think they're going to run fast to the upside. I just think there are opportunities that are there. The egg, IWM was the egg. We got stopped out yesterday because I tightened the stop when the market opened a little bit on a negative side yesterday. You can see it's going to open at 103.50 today, 60 cents ahead of where we got stopped out of the position. I'm not going to cry over it. The goal of the egg is to make 1% within 5 trading days. It made 5% in 6 or 7 trading days. I'm good with that. If it runs, we may buy it back, but there's plenty of opportunities that we're shifting and sifting through right now that will add back to the egg model. Financials is one of those, because I still think that on the financials, if you look at KBE, KRE, and KIE, all 3 of those, insurance, large banks, and regional banks, I still think that there's upside there. A lot of this rattling is worry about the Bernanke factor and how that's going to impact bank earnings going forward. Banks were running on the fact that as interest rates go up, banks are more profitable. And now that Bernanke's back in the picture, if he stalls interest rates, then that could put banks in a little bit of a precarious position about making money. That's the rationale. I'm not buying any of that crap. I think that banks are in a position that they're going to probably double earnings over the next 2 to 3 years, and I think you're going to see them continue to do well. The stress test keeps coming back on a positive side, and if lending on the housing side continues to be strong, I don't think that has to be stellar, but I think as long as it's consistent and strong, these banks are going to do well. They're doing more commercial lending than they have been doing in the past. So I think that what you're going to see is more profitability there. I think the weakness in the financial sector is going to come on the trading side, because I think trading is slowing. I don't think you're going to continue to see the trading accelerate, and those are the kind of things that I think you have to be a little bit more concerned about than anything else relative to the current outlook. Now, overall, coming into today's trading day, we're set up to really kind of, I guess, drift higher would be the best way to say it. We're up 0.3%, so we've added another 0.1% coming into the open right now. And if we look at SPY here, you can see that it's back up to around 168.10ish on the upside, 168.18 coming into the open. So that, it's a nice little move on the upside for the S&P. It may set a new high on the trading day, but the futures are good for about the first 30 minutes. After that, the market's going to trade based on what investors really believe on a forward-looking basis, and that's where you can't get caught up. I look at the futures to kind of see how the day's setting up, and then I look at between 9:30 and really 10:30, the first hour of trading. I want to know, were the futures right? Was the sentiment right? And if it was, then that's great. If it wasn't, what is it setting up to be, and what are traders really thinking on a short-term basis? I'm also interested in the longer-term charts and whether or not things start to erode. And right now we're not seeing any erosion that you could really speak of, and we are starting to see some bounces along the way. And one that has intrigued me has been Apple. And you can see Apple's going to probably open flat to its close yesterday. But Apple, we own the options on Apple we posted these down here under the pattern breaks. And you can see right in here that we posted the options on Apple. That's been a great trade to this point. And I still think there's upside in Apple, because there's still the speculation that they're going to announce an i5S or an i6 phone or some cheaper version of their smartphone, and the iWatch and iTV and all these things are being rumored out there, and there's a lot of headlines coming out about Apple rejuvenating itself. And all that is good and fine, but what really intrigues me is that if I pull this downtrend line out right here, Apple could still run upwards to 445, 450, and we're going to capture about 50% of that on the option move. So if it moves up another $20, let's say, then that's another $10 on the options. And the original options were $16.50, and the second tranche of options that we bought were around $18. I mean, that's still a 40 to 50% rate of return on those Apple options, and I like that going forward. Amazon is the same way. I bought the options on those. You can buy the stock either way, but I like what's going on with Amazon and Google, which we didn't really post, but I think that you're seeing some positives in these large cap stocks. You got some earnings tonight on Intel, IBM are two biggies that are coming out tonight. You also are going to have eBay, Abbott Labs are out tonight. So I think all of those kind of play into how the NASDAQ moves. And then some interesting things on the financial side is PNC, is going to announce earnings, and you can see that they're down. So I haven't seen what their earnings are, but they evidently weren't good this morning. So you can see a pullback to support on PNC, which is another issue. MTB is another bank. And you can see that that's going to break out of that flag pattern to the upside. You can see the open right in there around 118.45. So I'm watching some of the earnings on the financials because I'm looking for confirmation on the upside. We got it with Bank of America. We didn't get it with American Express. We didn't get it with PNC. We got it with MTB. So you're getting some mixed earnings out of that. Watch how that plays into KRE on the regional side and how it plays into KBE on the large bank side. And then the other piece of this, XLY, which is the consumer side, you can see pull back a little bit off of the retail sales data on Monday. I would watch consumer discretionary. I think it's right now it's one of the two key leaders of this market, which are financials and consumer discretionary. If they start to erode, then I think you get the pullback or test that a lot of people have talked about, me included. I still think there's a test coming relative to this upside move. So let me just summarize real quick what I think is important. One is that all of the data that I just rambled through, I don't really write all of that. We used to write it all and people said it was too much. I try to put most of it into the video update at night because I can talk about it and give you some clarity relative to what I see in the market as a whole. But coming into the trading day, what I've tried to do is the first half of this trading notes is the models and some sectors that we're looking at. And so what you saw are all the models, and then you can see that I talked about financials, some of what I just said in there, gold and what we think could happen there. And then the last thing I wrote in here today and have most of this week is manage the risk. I mean, I think that we're in a challenging high-risk current trading environment. Even though it doesn't seem that way, it is. And if the market gets pushed to the other side, I think the shorts come back into the market with a vengeance. But be cognizant of that is out there, and that's why yesterday's blog notes were relative to that. So you can always catch what's going on with the trading day right there. And then these pattern setups are just additional trading opportunities that I see. And today we had IHI, AT&T, and RAX. I like AT&T right now, and you can see we're getting the open there. So if you had your trade in this morning on AT&T, you did get executed right there at 36. So you can see, even if we pop this out to a 1-minute chart, you can see that you were able to get into the trade on the open, and so you own it at 36. A lot of people ask me, well, how did you get the trade at the right price? You just got to put the trades out there and see, trust yourself. If you don't want the trade, don't do the trade. And please do not go with hindsight and tell me that was a stupid trade. It's always easy to look back and say, oh, well, you should have never done that. Stop that. You have to understand that you have got to keep notes coming into the trading day as to what you believe to be true. Look at whether or not they were true, and then look back at what you didn't see. If you didn't see something that was blatantly obvious, fix that. If it just happened, that's the way it worked, get over it. I mean, we super analyze things to the point where we can't trade because we think we got to be perfect on every trade. You know, you do not have to be perfect. Everybody's going to make mistakes. Everybody's going to take losses. And if they don't, they're lying. I take losses every day on positions. I want to cut my losses, and that's the key, is that you want to be in a position that you can cut your losses. So AT&T actually hit IHI. This is one that's lower volume, so I'm going to have to use, I would use a limit order here, but the entry on IHI at 81, it hasn't even gotten close to that at this point. And then RAX with 42.35, and you can see that that's inching up towards that entry there on the cup and handle breakout. I like this stock. This is in the computer software space, storage. They're transitioning the company, which is why you saw the big downturn. But what I like this pattern setup. You got a cup right here. You got a little bit of a handle, and so what you're looking for is the break out of that handle, and then to fill this gap right here back up to around the $50 range. And so that is the pattern setup. But you have to know a little bit. Me personally, I know other people don't care about what these companies do, but I want to know, why is RAX in a position that it consolidated? Why is it in a position that it could break out? And is it a legitimate breakout on a swing trade? And if it is, I'm interested. If it's not, I want nothing to do with it. So I do one of the things I've said always is that we mix technical and fundamental data so that when we see pattern setups, we understand why they've set up that way, and we have more confidence going into the transaction. So you've got all three of those on the day today. You got other positions that are there, and you don't have to buy them all. You can buy one. You can, I tell people all the time, trade 50 shares, 100 shares, whatever you feel comfortable with, and learn how to trade with real money. I know a lot of people say use paper trading. I am not opposed to paper trading, but I find it's a little bit different when you have money on the line than when you don't emotionally. But learn to deal with your emotion. Up the size of your positions to see what happens to your emotions. At some point, you're going to get to a threshold of pain that you can't trade more than $25,000 in a position, or $50,000 or $100,000 in any one position. So you have to find where that emotional threshold is, and when you hit it, thinking you can talk yourself above that isn't really ever going to happen, because understand, 1 or 2% of gains or losses is always 1 or 2%. But if I've got $25,000 exposed and I lose 1%, that's $250. If I've got $100,000 exposed and I lose 1%, that's $1,000. That's 4 times the loss financially. That means you're now escalating your emotions 4 times. That's what you have to deal with, I think, as a trader, and learn those basics for entry, exit, and target. Learn how to get in and out of trades so that you can do it. So if we look at this, if we want to buy this, what was the entry price that we posted up here? $42.35, which it's already above that. We could have come in. I'm just using, this is a trading tool within Telechart, but I could have come in and posted my trade at $42.35, and I could have used a stop order, a limit order. I could have done it for the day, but if I say I want to buy it, and then I just place the order, then it submits the order, and you can see I'm now long 100 shares at $42.49 of buying it. Now, and then you can see it places the little trend line on the chart so that I know where I entered the trade, and it will stay there until which point in time I sell the trade. But the key to me is that you come in and you build your orders, you understand what you're buying for the day, why you're buying it, and that will help you be a better trader. I'm trying to give you a limited amount of notes so that you can glean what's here. If you want to take this further, use the tools that are available to you. Example would be, let's just go back over here, go to pull up a different, I'm just going to pull up Yahoo Finance. And if I go here and I can type in the symbol RAX, and what it comes up with is headline news. So let's say, now I'm going back to the previous part of this, which is, let's say you want to know more than what I wrote there. You can type it into here. You can see any news about RAX that's out there on the internet that has a deal with Yahoo. You can actually go in, and there's a ton of places to go to get any type of news. And the reason I go to Yahoo is that I can pull up any of those news articles off of Business Wire, Motley Fool, The Street, whatever. But what's more important to me is that I can come right here and I can gather company data right here. I can look at the profile, I look at key statistics, SEC filing, competitors, industry, components. I can look at analyst opinions, estimates, research reports. All of that stuff is posted right there. I got the financials down here on cash flow, income statements, and all of that. I can look at who are the major holders in the stock, insider rosters. I can look at any type of fundamental data that Yahoo has there. And I can do it very quickly. And I can get an idea as to why and what RAX is. And then maybe when it's posted on here, you have a little bit more confidence as to why you would want to buy that breakout of RAX. And so it gives you just a quick tool to look at and to learn a little bit more about each of the positions if they're stocks. If they're ETFs, then it's the same thing, but you might want to go to a different website and pull up a different, I'm not on my normal computer doing this, so I don't know if I have the favorites marked in here. But if you, whenever I find things, I always page mark them. For ways that I can go back to them quickly and look for research on them. I don't have the site that I'm looking for, but there's different, you can see I have a lot of ETF websites earmarked here. And all you have to do is there's a couple of websites. ETF Database is the one that I was looking for, but if you go to ETF Database, they have a lot of information on these ETFs that you can look at. A lot of it's free that you can dig into and look at what the ETF is and how it functions. But there's different ways to extrapolate the data quickly and focus on what you want to know out of what's posted here and how you can best use that to trade during the trading day. So the key to me is that when you come into the notes is, read them, highlight what's important to you. If you use Telechart, my recommendation is that you come into here, and right here you create a personal watch list, and you can put Jim's Notes, and you click OK. And now I have a Jim's Notes watch list, and if today I am watching AT&T and RAX and let's say Yahoo, just to put a couple of them in there, this gives you the ability to watch these. And then it's important for me is that I can come in here and create indicators of what I'm looking at. But on here you have what's called watch list tracking. So I can put tracking price. I can actually go in and look at where the tracking, so right here it says edit tracking values for T, and if I want to enter this trade at 36 and I'm going to buy 500 shares, I click OK, and you can see the tracking price is now 36, and it's benchmarked against that's the entry that we were talking about this morning, and it's at 36.23. And then I can also add to this what the tracking gain or losses, so I can see I own 500 shares of it. I'm up $109. I can also put in here on the watch list, tracking shares. I know how many shares I have, and I can come in and also add to this tracking percent. So I know I'm up 0.6%. And you get the point, is that now I have a watch list that every day when I go to it, I know exactly what I own, where I want, if I don't own it, what I want to get into it at. Because here, if I had tracking shares, in other words, when I come down here and edit the tracking values, if I have 0 shares, you can see that it will come up as 0 shares. So, and then the tracking price is 36, and if this price was 35.55, I know where I want to get into the trade at. It's a way to take the data off the website and actually build a watch list that you can flip through throughout the day and then trade off of. And if you trade within the software itself, then you can just click on here. I don't even know what symbol we're on. We're on AT&T, and I can put in my order right there as to where I want to buy AT&T, and I'm good to go, and I go on down the road. So the key to me is finding and dealing with things as simplistically as possible so that I can spend my time dealing with my emotions, because realistically, that's what it's going to come down to. And building these type of tools inside of your trading world are what give you the discipline to keep you from getting in trouble. It's about habits, it's about discipline, and it's about focus. That's what we've been talking about in the whatever we're calling it, the Back to Basics boot camp, or whatever my brother called it, trading camp. That's, you know, what I built that class for, was to give it to a few people, 15 people, and say, here's a way that we can learn and do the basics. You know, it's not about how to find the needle in the haystack. It's about how to create the needle in the haystack in your head, because disciplined traders are the best traders. If you're hit and miss, you win some, you lose some. Everybody can make money in an up market. When the trend is to the upside, it's easy to pick stocks. It's when the market gets jumpy that it becomes very difficult. And for 90% of the people out there, if you're like me, you shouldn't be trading during that environment. I get emails from a lot of people when the markets are volatile and saying, why aren't you trading? I don't want to trade in that environment. That's just brain damage is all that is. If I'm right, it's probably luck. If I'm wrong, it's probably luck. And, you know, it's just find the trading environments that work for you. Find what works and build it on a basic, simple tool that allows you to do it. That's why I use Telechart a lot, is because it's a simple tool that allows me to build my own trading screen and to do my own thing on a day-to-day basis, so that I can see things real time as to what's moving and what's not moving. And you know, it's just like if I look right now at, you know, what's moving in the trading day today, you know, you can see right here that SVXY is up 1.2%, IBB, and that's just my basic ETF scan that we've given out many times. I mean, there's nothing unique about it, but that's real-time streaming relative to what's going on. I can see that energy is on the upside today, so we just talked about energy earlier. So you're seeing it bounce back. For those of you 10 or 12 people who sent me an email as to why I bought energy, and you panicked yesterday and you sold it, you have to be patient with trades sometimes. Sometimes they take a little bit more effort and a little bit more time to develop, but don't panic. I mean, if it goes to the stop and you stop out, then you look back at the trade and say, what did I do wrong, and how could I have been better at the trade, and did I do anything wrong? Sometimes you didn't do anything wrong. There was just unforeseen news like yesterday, which was China. I mean, China's GDP data, let's say China's GDP was still growing at 6.9 instead of 7.1, and we're going to sell oil off 1%? Give me a break. None of that makes any sense. I mean, so when you just got to step back from the noise and say, I mean, the United States markets are up, whatever, double digits right now this year. We're growing at GDP. Q2 has just been revised down to 0.4% by USB, and Goldman Sachs and a couple other companies have come out now and downgraded to 1% GDP for Q2, and we're growing at double digits, and we're throwing rocks at China for growing at 6.9%. Go figure. You know, sometimes things don't make sense to me, and that's where you got to step back, take a deep breath, and trade your conviction, versus listening to some of the rhetoric that comes out of the media. So I hope that's helped you this morning. I mean, the focus is use the data as it's posted. I mean, make it work for you. The model pages, you know, they get updated each night relative to what's going on. And, you know, the key to me right now is we did get stopped out of, by the way, TBF yesterday. And I kind of like what we're seeing right now in the market. I do think that this, just in conclusion, we could see a little bit of a retrenchment, maybe 1 to 3 or 4% on this market over the next week or two. But I still think that everything is in place technically for the market to still climb higher. Not that I agree with that, not that I'm wholeheartedly behind why the market is going higher, but you can't fight the trend. You have to take it for what it is, and you move forward with it. And it's going to give us some good things, it's going to give us some bad things, but right now I think that the key is to be patient, let the market play out. If we do get a retrenchment, you'll see more buys come onto the watch list, and we'll move up from there. So overall, I think the market's kind of in a position where it's hell-bent on going higher, and we could see a little pullback and then move higher from there. But at some point, I do believe the fundamentals are going to matter, and I do believe the market does take a correction at some point, but I'm not here to tell you when that is. It will develop. It doesn't. No correction happens overnight, and no bull run happens overnight. So let the market speak to you day by day. You know, digest it and then go forward. So we also have, if you want to get on the waiting list for the next basic trading webinar series that we're going to do for 4 weeks for a limited number of people, and that it does allow interaction, by the way. We use GoToMeeting, which allows us to talk to each other instead of just me blathering on. But each of those sessions is about 90 minutes long, and they're once a week for 4 weeks. So we go through it on how to do it, and then you get a week to play with it, then we come back the next week and we build off of it a little bit more. But it's just trying to get back to the basics of trading. So if you want to do that, send Don an email, don@jimsnos.com, and we'll let you know when the next one is that we're going to schedule. Probably be mid to late August and into September. But the idea is to get you back to trading off of the basics, and that's what today was really about. So with that, guys, have a great trading day, and we'll see you soon.